My name is Bill Reichert, and I'm a managing director at Garage Technology Ventures. And I think the reason I'm here today is because Garage is a seed stage and early stage venture fund focused on investing in companies at the earliest stage. So we invest in companies at the same point that angels frequently invest in companies. So a lot of the deals we do with angels. So in fact, probably almost every deal we've done, probably 90% of the deals we've done, we have done with angels. So we have a lot of experience working with angels. And because we're seed investors, some of what we do is very relevant to thinking about angel investing. So the other part of my, so we started Garage in 1998, and a group of us came together, myself, a gentleman named, hey, Kayvon, all right, good to see you. Hey, come sit down, you'll learn something.
All about learning.
Yeah, exactly. So I get together with this gentleman named Guy Kawasaki and a few other people, and we started Garage with the intent of being the world's first venture capital firm set up for the benefit of entrepreneurs, right? That was our focus. And the idea there, having come from an entrepreneurial background, was to give back to the entrepreneur community as much as we can in terms of education, in terms of reaching out to them, in terms of providing resources for them. So we've done a lot of events. Guy obviously has written a lot of books and blogs a lot. We have guides on our website. A lot of stuff we do for entrepreneurs to help entrepreneurs avoid the mistakes that we made, learn from the successes we've had, and try to learn from each other as well. Prior to that, I spent most of my career as an entrepreneur. Started or co-founded or restarted 4 different venture-backed software companies. So come primarily out of the software industry. So that was most of my entrepreneurial background back. And one of the things that I noticed when I was an entrepreneur is, even though I did my first and I was totally naive. I did my second, I was less naive. I knew a little bit more. But as I progressed, I still realized there was just a lot of stuff about the whole venture process that was kind of opaque. That for whatever reason, the VCs weren't sharing. And so we decided we spend a lot of resource sharing as much as we knew about venture capital. So I was asked if, given our perspective, I would talk a little bit about our perspective on angel investing. And to be honest, we hadn't thought sort of systematically about angel investing that much. Spent a lot of time working with angels, spent a lot of time thinking about our own investment strategy, deconstructing what works and what doesn't work. And so I actually had to go talk to some of my angel friends and research what angels are learning from each other. And there's a fair amount of material out there to help educate angels. So I was going through some material on sort of what angels hear from experienced angels about what it takes to be an angel. And I thought, wow, a lot of this stuff doesn't seem quite right. It doesn't really seem to match my own experience. And it was actually a very similar experience to what I had when we started Garage and we went over to Stanford to find out what were they teaching entrepreneurs these days about entrepreneurship. And this is back in 99, 2000, and we realized, boy, that has very little to do with our experience as entrepreneurs. So I was having a sort of similar experience. And by the way, God bless Stanford. I went, before we get to, God bless it. The good news is over the last 10 years, Stanford's actually brought some seasoned entrepreneurs in. And so now they've been able to make academic what we all knew as entrepreneurs, right? Which is, my favorite one. My favorite is, now they call it the lean entrepreneur because, of course, what do you mean? A fat entrepreneur? Whoever, I mean, it's not like, as entrepreneurs, we ever had this notion that, oh, God, yes, we should conserve money, right? Okay, whatever. But it's good. No, it's a very. I mean, I don't mean to to disrespect anything that has been done because it's been extremely valuable to entrepreneurs. But back to angels. So I don't know. I don't know if there's some good, well thought out material that angels can learn from. But so I'm going to offer you, however, my own perspective on the art of angel investing, having listened to angels teaching other angels, with the exception, of course, of Gwen. And I'm going to push back. So what I'm going to do is stir the pot here a little. And what I'm going to do is I'm going to give you what, from our perspective, are the top 10 myths of angel investing, in terms of what I've heard angels say are key, but which I really think are somehow not exactly right. Starting with the first myth. The first myth of angel investing, I've heard this a number of times, you should invest in what you know. So, okay, that sort of makes sense, but the reality is that almost every winner you're ever going to have is going to be a black swan. In other words, even if it's, okay, so I know software, presumably, but I don't know software. I mean, I've invested in a lot of software companies, I've written software, I've done a lot of software, but there's so much in the software domain that I don't know, that to believe that software is what I know is probably more dangerous than it is valuable. And so I would suggest that it's dangerous to think, oh, well, let's see, I have a background in semiconductors, therefore I should only invest in semiconductors, or whatever it is. I just don't think it's realistic, and in fact, I think it might be dangerous. And what we have experienced over the years is almost every time when we go out, we see an interesting technology, and the process we go through is we go ask a bunch of smart people about the business and the process of due diligence, right? So we have a lot of entrepreneurs and friends who have been successful in different technology domains, and of course we go out and ask them. There's a very interesting phenomenon that happens. It's called the distortion of expertise, which is that if you have been highly successful in a domain, then you think you know everything about the domain. And so when some innovation happens in the domain, you think you have to be an expert in that innovation, and probably you aren't. And so you have a false sense of an understanding of something you really don't understand. And so what we've discovered is, rather than think you know something about a domain, institute a process to surface questions, concerns, and issues. And you may be able to surface some of them yourself because of your background, but more likely you're going to get it from talking to a bunch of different people. So the reality is you can't really focus on investing in what you know. You've got to focus on investing in the best damn company you can possibly find. And then figure out, how do I determine whether or not I'm making a good investment decision? So myth number 2 has to do with focus on making money, right? At the end of the day, if you want to be if you're an angel investor, at the end of the day, your focus has got to be on making money. Now, I think Gwen made some very good points earlier about a lot of angel investors have other motivations for why they're investing. Now, I would suggest, though, that some of the time when angels say they have different motivations is because it was a good deal that didn't work out. But frequently, though, where I'm focusing here is when I hear or see angels behave in a given circumstance around a deal that's a hot deal. It's a hot deal, and we got to get in. And the way the deal's being pitched is, this is the last round before the VCs get in. And Sequoia says they're going to give it a $15 million pre-money valuation, and so you're going to triple your valuation if you squeeze in now, and bam, you're going to make money, right? Or these guys, they've launched the company, they've got 1 million downloads, they haven't spent anything on marketing, and Google's talking with them. This is your chance, because Google's probably going to buy them next year, and we're going to flip it, we're going to make a lot of money. And so there's, you see angel investing out there, and unfortunately, around here, it's kind of a problem. You see these deals get these runaway valuations from angels because they think they're going to be able to flip these deals quickly. And there's this whole new culture in Silicon Valley around the fast flip. that is causing a lot of angel money to kind of figure I can put it in and I can flip it fast and I can make a lot of money. And I would submit that you will find a lot of people who've made a lot of money doing that, but that's a false positive. The chance of taking that approach and being successful is lower than is low. And so at the end of the day, you've got to focus on creating value. You've got to focus on finding a company that can do something better than anyone else on the planet, that can make life better for their customers, for their users, whoever they're creating a product or service for. You've got to create value. You don't create wealth without focusing on creating value. So focus first on what does this company do, and is it really of value? Is it something important in some fundamental way that's hard for other people to do, if not impossible? And that, I would submit, is a better investment decision. Now, you will see these stories of these crazy companies that came out of nowhere and got sold for $1 billion because they figured out how to share photos. And you'll think, maybe we can invest, maybe this is the next Instagram, right? Don't get carried away by this idea of a fast flip. Focus on the fundamentals. Myth number 3. The key is good due diligence. I'm so glad that Glenn put that chart up. So, I love it when I see without disparaging anyone, you see there are some investors who have these massive due diligence checklists. And the thesis is, if we de-risk every corner of this opportunity, that will make it a better investment. And due diligence checklists are primarily about de-risking. It's about checking to make sure that none of the founders is a felon, or checking to make sure that the intellectual property is free and clear. Both of those are good things to do. You should do them. And you should make sure that those are done. But that's not the key to being a good investment, right? The key to being a good investment is the pathway to success, not the flaws in the investment. So, yes, you have to check for what the facts are underlying it. But the reality at the end of the day is it's understanding and visualizing the pathway to success, not checking off the boxes on a due diligence checklist, that's going to make it a good decision. So once again, I'm not saying don't do due diligence. Don't take that message. What I am saying, though, is there's a lot more to figuring out if an investment is good than just doing the due diligence. And part of that is what, for want of a better term, you call intuition. It's this broad, holistic understanding, not just of a set of data points, but of this pathway to success. Myth number 4, which is related to the last one. Don't let emotions cloud your decision. So I hear this a lot. And this is classically derived from standard investment theory, right? And so, the Wall Street stock pickers and, all the books on how to invest in stocks, right? All the books tell you, don't let your emotions cloud your decision. Don't get carried away with a stock, and, when a stock goes down, don't get emotionally attached to it, and all these things that investment advisors say are bad about emotions. But the fact of the matter is, investing in startup companies is extremely different. Very different than picking stocks, than investing in public equities. And the reality is, emotions are data. Your emotions are data. And as Gwen is saying, it's all about the people. And your emotional reaction to the deal is as much information as the data you can collect. And so it's not about denying your emotions, it's recognizing your emotions. When you discover that you've fallen in love with a deal, everybody, the reason investments get done. Now, how many of you guys have already done some angel investing? Right? Okay. So I'm guessing, maybe I'm wrong. I mean, from my own experience and my compatriots, frequently what you discover is the reason you wind up investing in a deal is because you fall in love with it. And then you figure out a way to make sure you're not making a mistake, right? But, so you fall in love with deals. And, you know, my experience is you fall in love with different things. Some people fall in love with the people. Some investors fall in love with the team. Some investors fall in love with the technology. You know, and some investors fall in love with the vision of changing the world. There are all sorts of ways you can fall in love with a deal. So the trick is not to just deny that reaction. I love these entrepreneurs. Well, that's an emotional reaction. You know, you should discount it. Let's go get the data and figure out, you know, are these good entrepreneurs or not? Well, they just got out of college and they've never done this before, and, you know, they're, you know, newbies at it, so the data says they've got to be lousy entrepreneurs, right? But, you know, if that's your only data set, you're going to discount them as potentially good entrepreneurs. But you love them. You love them. Why do you love them so much? You know, because they're smart and they're articulate and they're nimble and they have good answers and they're passionate and they're enthusiastic and they get things done. You know, that's data. That's useful data. So don't reject it. Myth number 5. Build consensus among a syndicate of investors. So there's a big controversy now in venture capital around the venture firms as to whether or not it's important to have unanimous decisions in a venture firm around making investments. And so the angel groups have adopted a sort of similar concept which is actually more flexible. And it says, okay guys, who's in, right? And so you get a group of people who come in. People who don't want to come in don't have to come in, and people who want to come in do come in. So that's a good sort of, you know, metric of sorts. So one of the challenges, though, is you're with a group of people and you like this deal, and there are a couple of your buddies who don't like it. What do you do? So in a venture firm, frequently you have this sort of voting rule that says, okay, you know, the 3 leads have to agree, and then we got to get at least half of the rest of the team, whatever the voting rule is. But the interesting data that's come out of looking at this is the reality of most good investments is that the best investments were ferociously disliked by some of the prospective investors. The best investments tend to be controversial investments. And that intuitively makes sense, right? Because if everybody thinks it makes sense, then at some level it's probably both mediocre and has already been thought up before. So it's the things that are a little bit out on the edge that are controversial that tend to break out and become these brilliant investments, right? No venture firm could sit around their office and listen to the initial Twitter business plan and say, yeah, that's brilliant, right? There's no way anybody could do that, right? And yet, arguably, it's brilliant. Now, I don't think even the founders expected it to be brilliant in the way that it has become brilliant. You know, flip side, Facebook, you could sit around the table and, you know, you could get a lot of people to say that is brilliant, but you'd get a bunch of people saying, oh no, it's just another MySpace, or it's, you know, there's got Friendster, you got MySpace, you got all these other companies out there. Why do we need another social network, right? You know, same deal with Google. Oh, you got all these search engines, you know, so they got this clever thing. Why do you need another search engine? The best investments tend to be controversial. And so be aware of that. Don't disregard the controversy, but instead go to those people and say, why do you think this is a dumb idea? And find out if it's an emotional reaction, if it's because, you know, they're experts, and of course in their expertise it's not a good idea. Find out what it is that causes them to reject this investment. Myth number 6. This is going to be a particularly controversial one, I think. Myth number 6, success comes from adding value. And so there's this conception of smart money, a conception of smart money and passive money, right? And so, you know, they don't ever call it dumb money, but, you know, the entrepreneurs call it dumb money, but they don't call it dumb money out loud, right? So there's smart money and there's dumb money, and the smart money is the angel investor who's got the tremendous background and has an incredible Rolodex and is going to dive in and help out and work hard and be, adding a lot of value. Because you want, as an entrepreneur, entrepreneurs are constantly coached. You want smart money. And if we have time, I'll tell you what I thought when I was an entrepreneur when I was being told that. I just want money. That's what I want. Don't give me this smart money crap. The reality is, so this is the controversial part. So if, as an angel investor, I predict that the harder you work on a given investment, the less successful that investment will be. That's my prediction for all of you. Now, that seems a little bit odd, doesn't it? A little counterintuitive. The reason this is true is, related to what Gwen said, which is angels jump in, all of us, venture guys jump in. We wind up jumping in when there's a problem, right? So, the investments that have no problems, that sail through to the world of, nirvana, or IPO, whatever the case may be. Those investments don't take any work. You just put your money in and you watch the team execute, and it goes through the, goes through the roof, and hallelujah. What value did I add? Well, I was there for them if they needed me, right? It's the ones that get into trouble. And once a deal gets into trouble, almost by definition, you've lost some value. Now the question is to whether or not you can recover all that value and more, maybe, maybe not. But, statistically, the harder you work, the less successful the outcome is going to be. Not because you're bad, or it's not because we don't add value. It's because it's when the deals get in trouble that you have to work hard, that they really, really wish you could add some value. And that generally means it's on a negative path, not on a positive path. So what does this mean in terms of this whole smart money positioning, et cetera, et cetera? When we started Garage and when I crossed over, having been an entrepreneur and having heard all these VCs, I was extremely lucky that in a bunch of my companies, we had competitive term sheets and we had VCs that were trying to convince us that we should take their money. It was like, oh my God, this is amazing, right? And at the end of the day, as an entrepreneur, what I concluded through all these rounds, having had some brilliant VCs on my boards, at the end of the day, the greatest value that an investor adds to a startup company is to make sure the next round gets done. Because in terms of competency, you want the entrepreneurial team to have the executional competency in order to invest in them. You should not invest in the company if they have this big fat gap that you are going to fill. That should not be your role as an angel, I would argue. There's some angels who might think, oh, they're good at this, this, and this, and I'm good at the big hole here, so I can help them with that. And I would submit to you that's dangerous, because it's not your full-time job. It won't be your full-time job. You will let them down. What you should do instead is insist that they hire the right person to fill that gap. And you can coach that person, you can advise that person, you can help that person, but don't take that job on as an angel investor. If there's a hole in the deal, wait till it's filled before you invest. Don't invest and then hope you can fill the hole. That's my argument. Would you wildly disagree, Gwen?
No, I think that's a really good point. And if you have some functional expertise, you can even refer people that you know
right.
for the position. But it's true. You get into trouble because you're juggling again too much.
Right.
And you're trying to do that plus something else goes to a different company.
Right.
Yeah.
So, okay. Myth number 7. Make sure you protect yourself. So Gwen touched on this as well, which is the angel whose buddy estate trust lawyer says, you know, okay, I'll help you write the documents for doing this deal, and I'm going to make sure that no matter what happens to this company, you're protected because you're my client and you're my buddy, and I'm going to make sure you're safe. And that's a bad idea. You know, as Gwen was saying, it's not about control. The point in angel investing is it's important for you to enable the company to be successful. And to enable the company to be successful, you've got to follow certain standard rules of investment that don't poison the company for future investment. So you don't want to set up terms under the guise of protecting yourself to, you know, like you individually have the right to all the patents and the assets in the company, you know. I mean, that's not going to work, right? So you don't want to structure a deal in such a way that the next investor who wants to put money in is going to look at the situation on the ground and say, you know, yuck, you know, why would I invest in this company given what this investor has done to this company? Now, we've seen the world has gotten much better, you know, over the years from the early days of angel investing, and generally angels don't do this, but every once in a while you still see angels who are a little too clever by half and they put in terms to try to protect themselves. You know, don't do that. If you don't trust the investment, don't put money in the first place.
So can you just mention a couple of the common ones that people sometimes want to put in and they mess up each other?
Well, you know, probably the worst, most common one is taking too much of the company. So that's, you know, taking like 51% ownership, or, you know, taking so taking too much of the company with a small check messes up the cap table. So that's probably the most common one. The second most common one is taking too many board seats, where, you know, a friend of mine who should have known better, he was desperate, he raised money from an angel. The angel, as part of his investment, even though he didn't control over 50%, he didn't have voting control of the company, he had voting control at the board level, which was like, insane. I mean, and you know, it was shameful and shocking. And then, you know, from that, you go down the list to some of the other items like preferences, whereas an angel, you put in, you know, I want a 2x preference, you know, for my first check-in, whatever it is. Or in anti-dilution, I don't ever want to be diluted. I've seen people play with the preferences early on. Not too many people play with dilution, but I've seen full ratchet dilution from an angel. So now, I mean, as I say these things, full ratchet dilution and liquidation preference. Okay, right. So these are some of the mechanical things. But I've seen angels mess up companies in some of those different ways. Okay, I don't know if there's anything else you want to add.
Actually, I was going to mention the full ratchet.
Yeah.
And as a group, it's interesting when some members say, we want that. Other members say, well, wait a minute, we know that if we demand that, it sends the wrong signal.
Right.
As well to the next round.
Right.
So,
right. Right. And there's a longer argument on why you're probably better off if you don't do that to begin with, if the company's going to raise any more money. Myth number 8, valuation is important. You know, there are angels and angel groups that have firm and hard rules. I will never invest in a deal with a pre-money over $2.5 million or something like that. I mean, and I'm not saying valuation is unimportant, but I see too many investors get overly focused on negotiating that valuation down, you know, because I want to get a good chunk of this company with my round of investment. And so what they do is they don't focus on what's really important and what's really going to make the company succeed or fail. And that's the whole area of shared expectations and an understanding of the path to success. And so what happens practically, when you get to the point where you decide you want to invest, you put a term sheet on the table, and everybody focuses on the term sheet. And there's nothing in the term sheet about the pathway to success for the company. It's about all these technical terms with valuation screaming as the number one, and then the option pool and the board. But these things about numbers and technical terms become the intense focus of the process in the moment when it's most important to really find out if you're aligned around the future of the company. And that's why every single investor, venture angel investor, has what they call the first board meeting surprise. Because you go through this horrible process of 2, 3, 4 months of negotiating these term sheets, where the only thing you've talked about for 3 months is, you know, these terms and the lawyers and the documents and, you know, all these sorts of things. And you finish the deal and you show up at the board meeting and all of a sudden, oops, you know, we're way off our operating plan. Well, why is that? Well, because you took so long closing the deal. You know, that was 4 months ago and now it's June, whatever. And so because you're not focused on the right stuff, you get this misalignment and then you're off track day one. So valuation is not unimportant, but what is really, really important is just staying in tight communication around the alignment of expectations along what is the pathway to success. Myth number 9, it's really cheap to start a company now. So it's a great time to be an angel investor, right? Because with $1.50, you can fund an entrepreneur over the weekend, building a product, launching on Monday, and they can reach 2 billion people around the world. Life is good, right? I mean, so it's a great time to be an angel. You know, but the reality is, it is still really, really expensive to build a successful company. And, you know, look at all the data, right? I mean, how much money has it taken to get Twitter to where it is? And how much more money will it take? You know, I think we're up to about $1 billion now with Twitter, right? I mean, Facebook was well over $1 billion. Groupon was well over $1 billion. You know, all these companies that take all these, like, easy to start companies. Facebook was started over a weekend, right? and it took $1 billion to get them to, over $1 billion to get them to their IPO. It's really, really expensive in almost every domain. Now, there are exceptions. There is such a thing. I mean, people think of clean tech as being capital intensive and consumer internet as being, you know, capital light, right? But if you look at the money spent on, you know, on comparable companies, it's about the same in terms of how much Facebook sucked versus how much Solyndra sucked. Now, Solyndra didn't succeed, right? But whatever, Tesla. Tesla's a better example, right? Tesla, Facebook, you know, Facebook's worth a lot more, but you would think Tesla would be 2 orders of magnitude more capital intensive, but it isn't. It's not even an order of magnitude more capital intensive. So the point is, as an angel investor, no matter how cheap it is at the beginning, you've got to figure out what in the sector you're in, how much is it going to cost to be successful? And what does that mean for your capital position in terms of dilution over time or the requests from the entrepreneurs for future money for you? And myth number 10 is the standard, you know, again, this comes from investment 101 courses, right? You're supposed to diversify your portfolio. And, you know, yes, if you have a choice of public stocks and public bonds and gold and real estate and whatever it is, yes, you should diversify, but you cannot diversify an angel portfolio. You should focus on just finding the best investments you can possibly find. And focus on diversifying your overall portfolio. So your angel investments are that, you know, sort of screwy radical piece of your overall portfolio. If you're worried about, you know, sort of managing return or managing risk, manage that risk outside your angel portfolio. Don't, you know, invest in different sectors simply for the sake of diversifying your portfolio. Okay, a couple of other quick comments. What's the time?
You've got 10 minutes.
Okay. Okay. Some other, you know, observations, tips, comments. Your influence is not based on the size of your check. So that works both ways. So if you write a big check, you probably think you should be a big dog at the table. And certainly VCs think that way. But that may or may not be true in terms of your ability to have influence. Because the flip side of it is, if you're not the biggest check, that doesn't mean you don't have influence. You have influence to the extent that you have good communications with the team, that you understand the pathway to success, and you provide good advice, and you provide additional assistance to the team. So your influence is not a function of your check. Your influence is a function of your other, as Gwen said, soft skills in working with the team and working with the company. Buy high, sell higher. I mean, again, public investment, investment management 101 says buy low, sell high, right? And the fact of the matter is there's no such thing as a cheap startup. Every startup that gets funded is way overvalued, arguably, right? I mean, absurdly overvalued by any Wall Street measure of value. So don't try to figure out a way to get a bargain. The point is, you can't get a bargain in investing in startups, right? You want to invest in good companies, not in cheap companies. Another tip, don't chase fads. Our thesis at Garage was, as soon as a sector had a name, then it was too late for us. So, we invested in clean tech before it was called clean tech. We invested in Web 2.0 before it was called Web 2.0. We stopped investing in Web 2.0 after it was called Web 2.0. And, may or may not have been a good thing. We backed off of clean tech after it got to be hot. Now we're getting back into clean tech, now that it's down. So don't chase fads. I mean, it feels like, it's great for cocktail party conversation to say you invested in the next Facebook social media network startup that's going to it's going to beat Facebook or whatever it's going to do. But it's tough to chase a fad because there are so many competitors in these sectors once they become hot. Our thesis is find a technology, a sector that is underdeveloped, that has a sustainable competitive advantage, where there aren't going to be 12 venture-backed competitors in the next 6 months. And that's probably a safe way to invest. Monitor the surprise ratio. So surprise ratio is, as you're working with the team, particularly before you invest, as you're working with the team, you will be surprised a lot, right? Mainly, there'll be negative surprises. Mainly, they'll say, we're going to close a deal in 2 weeks with this great company. We got the purchase order. We're just waiting for the lawyers to sign the paper, right? And 3 weeks later, you ask how that deal went, and you discover, well, the lawyer was on vacation. They haven't done it yet, and blah, blah, blah. That's a negative surprise. Rarely you get a positive surprise where the entrepreneur calls up and says, hey, we just got a purchase order we didn't expect. You don't get that very often. So your surprise ratio of positive to negative is generally very close to 0, right? Unfortunately. But it is generally going to be a number less than 1 that is going to be closer to 0 than to 1. It's an indicator. This is a form of due diligence we do. We pay attention to what the entrepreneurs promise and monitor the entrepreneur during the process. Now, the dirty little secret about venture capital at the seed stage that we don't like to tell entrepreneurs is it takes months to get a deal done. One of our companies, one of our most successful companies, it was almost 2 years between the time that we met them and the time we were able to pull together a round, the first round for the company. It was almost 2 years. And we were working to get the round pulled together. I mean, it wasn't as though we were just kind of ignoring these guys. So, that can happen. But what happened was, during that period of time, the entrepreneurs just kept getting better and better and better and better. And we had real data that told us, hey, these guys are on the right trajectory. Usually it's, it's closer to 4, 6, 8 months. But if you're paying attention to what the entrepreneurs promise and their execution and their follow-up, that's much better data, I think, than an IDG report that says something about how many widgets are going to be bought in 2018. You know, you put that in the binder because somebody wants you to put it in the binder, but it's irrelevant. It's what the entrepreneur promised last week and what he delivered next week that is much better data. Lower expectations do not result in higher returns. What does that mean? So there's this thesis going around that it makes more sense to shoot for a $50 million exit than to shoot for a $500 million exit. Because if you look at the data, many, many more venture-backed companies sell for $50 million than sell for $500 million. So the logical flaw is, therefore, I should try to get a $50 million exit investment, not a $500 million exit investment, because there are more that hit $50 million. But that is a logical flaw. If you start out to shoot for $50 million, the chance of you hitting your plan is not significantly greater than if you start out shooting for $500 million. You know, if you have a smaller scope, a smaller opportunity in mind, you know, you have a scaled down chance of success. So I don't know if there's anybody who's ever going to be able to prove this definitively with data, but I would argue that for an entrepreneur to say, I don't want to try to build a $500 million company, I want to try to build a $50 million company, should not enhance that entrepreneur in your eyes as a good investment opportunity. That would be my argument. So, and my last tip, of course, is the famous line, the smart person learns from his or her own mistakes, the wise person learns from the mistakes of others. So all this goes back to Gwen's point, network, connect, learn, learn, learn. See what works, see what doesn't work. The thing that neither of us have really mentioned that I was realizing as I was talking is almost certainly the single biggest factor in your success as an angel investor is deal flow. Right? It's almost certainly that is the single biggest factor, is having the opportunity to invest in a great company. So it's not good enough to know how to invest in a great company if one should come along. You've got to figure out how to have the opportunity to touch a great investment, and that means you've got to figure out how to develop your deal flow. And that's what these networks are all about. And that's what communities are all about. And so a great angel investor is more than just a great analyst of startup companies. A great angel investor is someone who connects with everybody in the ecosystem to make sure that if there is a great company somewhere bubbling up, they have the opportunity to touch it. So that's my last tip. And so if you have any questions, comments, if we don't have the opportunity to answer them today, feel free to send me a note and say, Bill, I don't get what you meant by this, or I think that was the stupidest thing I ever heard, or whatever you want to share with me to my email address. And if you have any entrepreneurs that are interested in tips for success, we have a lot of guides on our website to help entrepreneurs, as I said before, avoid the mistakes that we have made in the past. So, any questions? Yes?
You're talking about deal flow. I'm just wondering, do you partner with angel groups to be follow-on funders of some of their initial seed funding rounds?
Yes. I mean, it's usually, well, some more formally or some more semi-formally than others, but we like to make ourselves known to all angel groups and like to have the opportunity to see deals at the earliest stage. So it's, frequently we won't be as early as some of the angels. So usually there are one or two angels who are friends who might put some money in, and then you're trying to aggregate a larger round with the angel group, and we'll frequently come in with that round with some co-investment money. And then what we like to do is get some other like-minded funds in the deal with us. So then we'll try to reach out with the angels to get a larger syndicate behind it. So that's usually the way, we like to work with angels. Okay, yeah?
You call this a myth or a tip?
Which one?
So many companies that you're going to invest in provide zero return, that a good number to shoot for in your portfolio is 10 investments?
It's a myth. I think, you know, it makes intuitive sense. But it gives you kind of the wrong frame. You know, it sort of says, okay, I got to get to 10, right? And, you know, so I would say you're more likely to have a success if you have 10 than if you have 5, if you apply equal intensity to each of them. And then you're more likely to have success if you do 20 than if you do 10. But should you target 20? That's tough. Depends on, you know, how big your partnership is. You know, you could do 20 if you have 3 or 4 people you work with intensely in sourcing and doing deals. So yes, the more shots on goal, the more likely you'll have success. Also, the more shots you take, the more you learn. And, you know, there is, you know, we're not allowed to say out loud publicly that we ever made mistakes because we wouldn't want our LPs to hear that. You can say that. You can say that because it's just your, you know, your spouse or whomever, I don't know. Whoever else cares about the money you're investing. Yeah, you clearly learn as you go. And so, yeah, the other tip I would say is do some number of small investments to start with. You know, depending on how many you've already done. Do some number of small investments and find out, you know, what your surprises are early on. You know, again, depending on how much money you've got and what your framework is, I would approach it that way and then ramp it up as I progress. But you know, the other model is to buy lots of options. So there's a model out there that says, and this is the Ron Conway model at scale, right? So Ron Conway's model is he'll write a $25,000 check to just about anything that'll fog a mirror, right? And you know, and the thesis being that you know, and his standards are a little better than that. I don't. But the thesis is he's now got an inside track on the ones that pop. Certainly he could write a $250,000 check then, and he wouldn't get squeezed out, right? So if he had to put $4 million to work, then he would get squeezed out. But the advantage you've got as an angel is you're not likely to get squeezed out if you're a good angel. So you can play the option game in ways that a VC fund can't. So all of that says it makes more sense to do a number of small bets, learn, and then follow on with larger bets. That would be, there must be schools of thought that are emerging around this model.
Yeah.
I don't know, but.
You know, actually, I heard Carol Sands say in one of her classes.
Yes.
The same advice. She said, think about starting with 10K per company. And you know, I was surprised that she made that recommendation. Because her own fund is, you know, higher minimum. But
right.
she just said that way you definitely, there's nothing like the experience.
Right.
Getting in, learning about the company, why, you know, keeping notes, why you made the decision you made, what did you learn, and then go from there. I think that's really good.
Yeah. The trick is you got to put the same amount of work into it as if it were a larger check, because otherwise you won't learn, right? Oh yes.
Do you ever look at an opportunity and then say, gee, if this company can achieve these 3 milestones,
right,
in this time frame, we're really interested, and then watch it with an angel group?
With an angel group, you know. Our process is we have a short list, you know, so we have a top 6 list, and of this top 6, we have a top 3 that are tracking into investment, and then the next 3, and we're just sort of continuously monitoring and managing. We generally don't. I mean, we don't see a company and say we really love this company, or we would really love this company if only this. You know, because by definition, a startup company always has another this, right? So either you love it or you don't. And so then the question is, when do you write the check? And that's different. But yeah, I mean, but we do pretty much love or not love day one. It's been extremely, there's one example. There is one, now that I'm thinking about it, there's one example of a company that came to us, brought to us by one of our friends, and we looked at it and we said, you know, we're not convinced. And then 9 months later, they came back, having gone from pre-revenue to post-revenue. They were going to go to their Series B, and it was one of those, Bill, you know, we can sell the rest of the Series A, and that'll give us cushion, and we'll give you the same terms you would have got 9 months ago. And the company was a different company at that point. And so we did fall in love, and it was brilliant. It was a brilliant deal, but we got to quit. I know. Okay.
Thank you so much.
All right.
Really appreciate it.
Well, thank you all very much.